Okay guys, so the May inflation report just dropped yesterday, and the number came in exactly as feared. Inflation hit 4.2% for the month of May, the hottest reading in the last 3 full years. And when a reporter asked President Trump in the Oval Office yesterday morning whether he was worried about it or not, here is exactly what he said. And guys, I want you to hear this clearly because it tells you a lot. Trump told reporters the numbers were great. And then he proceeded by saying, "I love it. I love the inflation." Those were his exact words. The President of the United States, on the day that inflation hit a 3-year high, while millions of Americans are struggling to afford groceries and gas, he said that he loves it. Now guys, I ask that you stay with me all the way to the end of this video because I'm going to show you what this inflation number actually means for your interest rates, what the Fed is almost now going to certainly do, and most importantly, what this means for your money going into the second half of 2026. Because the picture that is emerging today is one of the most important financial developments of the entire year. Okay, so let's start with the actual data because the number itself is concerning enough. But what's really alarming is the speed at which it's moving. Guys, just back in February, inflation was running at 2.4%. That was manageable. That was close to the Fed's 2% target. And things felt like they were headed in the right direction. But then the war in the Middle East broke out on February 28th, the Strait of Hormuz got disrupted, and energy prices started surging. March came in at 3.3%, and then April hit 3.8%. And now, as I expected, May is at 4.2%. Guys, that is a straight vertical lineup. Inflation has nearly doubled in just the last 3 months. And here we are, only 11 days into June right now, which means June's CPI report won't drop until July. If we're already at 4.2% through May, where does June land? Is it going to be at 4.5%, 4.6, 4.7? We are so far from the Fed's 2% target rate right now that the gap is almost hard to comprehend. Core CPI, which strips out food and energy, came in at 2.9% annually, which was actually in line with the forecasts. So the core number is more contained. But that framing completely ignores the fact that food and energy are the two things that hit Americans every single day. Stripping them out just to make the headline doesn't look better. It doesn't change what you're paying at the pump or at the grocery store. And right now, both of those are painful for a majority of Americans. So, with that being said, let's talk about the political response to this because I think that's important to understand what Trump's "I love inflation" comment actually signals. And it's more nuanced than what might appear on the surface. Trump didn't dismiss the affordability issue as a hoax or a claim that he was bringing down the cost of living. Instead, after the government said inflation spiked to the highest level since 2023 of April, Trump praised those numbers. His argument is simple. He believes that once the Iran war ends and oil starts flowing freely through the Strait of Hormuz again, inflation will, in his words, come down like a rock. Trump implied that inflation would drop when the war against Iran is over, saying that we've been taking out millions of barrels of oil right now. But again, here's the thing. He might not be entirely wrong about the oil piece. If the Strait of Hormuz fully reopens and energy prices normalize, headline inflation would likely come down fairly quickly because energy is the primary driver right now. But I will say, here's the problem with betting everything on that outcome. As of yesterday morning, the US is still sending what the script describes as friendship missiles, meaning there is no de-escalation happening right now. The situation in the Strait of Hormuz remains at a state of limbo, and as long as oil is not flowing properly, energy prices are going to keep going up, and inflation is going to keep on following that. Trump's unexpected comments may actually buy Kevin Warsh a reprieve from expectations to quickly lower interest rates. If the president is unconcerned with the highest inflation in the past 3 years, that gives the Fed political cover to hold rates where they are or even move them to higher rates without triggering a public blow-up from the White House. And guys, that's actually a meaningful development for the financial markets. Now, I just want to quickly say, if this video is giving you any value so far, please show some love by smashing that like button, leave a comment down below, and subscribe. Your support genuinely helps this channel grow, so please show some love, guys, by smashing that like button, commenting down below, and subscribing. Alright, now let's move on to the next segment. Okay, so let's look at what this inflation report means for the Federal Reserve's next meeting on June 17th. The market is currently pricing a 96.2% probability that Warsh does not change interest rates at the next week's meeting. And that makes complete sense. You don't make a dramatic policy move at your very first meeting as a new Fed chair, especially when the data is this mixed and the political environment is this charged. But here's what the data is saying about the rest of the year, and this is where you need to pay very close attention. There is now a 68% probability that interest rates will be higher by the end of 2026. There is a 30.8% probability that they potentially stay the same. And there's only a 1.2% probability, or essentially zero, that rates are lower by this year's end. The conversation has completely flipped, guys. At the July 29th meeting that's going to be upcoming, there's already a 12.3% probability of a rate hike, up from essentially nothing just a few weeks ago. And remember, even if they don't hike up, the expectation of higher rates for longer is itself damaging to the markets, to housing, to business investment, and to consumer borrowing costs. And so I just want to share a concept worth understanding. A strong jobs report now sends the stock market down, and a bad jobs report sends it up. That sounds backwards, I know, but I want you to think about it. A strong jobs market gives the Fed no reason to cut rates. A weak jobs market gives them an excuse to cut it. And the stock market has been running on cheap, easy money since 2008. So anything that threatens to keep that money expensive sends markets lower. That's the world that we're operating in right now. Okay guys, so as I wrap up this video, let me go ahead and give you the honest big picture assessment, because I think you deserve a straight answer on where all of this is heading rather than just individual data points. We are in an everything bubble, and I mean that in the most literal sense. Long term, the trajectory of asset prices is up because the debt-based economic model requires it. Governments cannot afford prolonged recessions, and every time things break, they print more money, which pushes asset prices even higher. That is the long-term direction, and I am long-term bullish on that thesis. But in the short term, we are dealing with a genuine energy shock from the Iran war that is pushing inflation up fast. A Federal Reserve that now has its hands tied on rate cuts, a stock market that is sitting at elevated valuations right as the biggest IPO wave in history is about to hit, and an American consumer who is carrying record debt levels with wages that are not keeping up with these inflated prices. Guys, again, just to let you know, wage growth came in at 3.4% in the month of May jobs report. And as I mentioned before, inflation is now at 4.2%. Guys, that gap of 0.8%, that difference represents real purchasing power being lost every single month by working Americans. When the overall inflation number is paired with the change in hourly wages, there is a bleak sign that people's spending power relative to their earnings has declined. And the midterm elections are coming up in November, which means that every politician in Washington is very aware that the economy is the #1 issue on voters' minds right now. The political pressure doesn't solve the inflation problem, but it does create urgency around the Iran negotiations in a way that pure policy logic alone might not. Okay, so here's what I actually want you to take away from this video, because understanding the situation is only half of the value. My position remains the same. I'm long-term bullish, short-term cautious. And here's what that practically means for your money right now. First, guys, do not mess with margin debt. I cannot say this clearly enough. A rising rate environment with an oil shock and an accelerating inflation print is exactly the scenario where leveraged positions get wiped out fast. If you are borrowing money to invest right now, you are taking on the risk that the data does not support. Secondly, buy the dips with real money, not borrowed money. If the market pulls back as inflation stays hot and rate hike expectations build, those dips are buying opportunities for long-term investors who have the cash and the patience to hold it. That cash that you've been building is exactly for moments like this. The third thing is stay diversified. An S&P 500 index fund, some international exposure, precious metals, and a cash reserve is the portfolio that navigates this environment better than a concentrated bet on any single stock. And fourthly, the last piece of information I want to share, just watch the Iran situation and the Strait of Hormuz more closely than you watch any earnings report or Fed statements right now, because that is the single variable that determines whether inflation peaks here or keeps climbing up 5% and beyond. If the Strait of Hormuz reopens and oil normalizes, this whole picture changes fast in a positive direction. If it stays in limbo or it escalates, we are in for a very difficult second half of the year. So please, please stay informed, stay patient, stay invested for the long term. And guys, that's it for this video. I would like to thank you for watching this video all the way through. Please like, comment, and subscribe so you don't miss any of the updates that I'll be sharing on this channel. The history of what's happening right now is moving faster than almost anything that I've personally seen in years. So again, I really appreciate you tuning in and watching this video all the way through. I post new videos almost every other day, and please comment down below. Let me know what you think. Is Trump right that the inflation drops like a rock when the war ends, or do you think the damage is already done? Thank you guys, and I'll see you in the next video.